Hello there, this is Alan Gassman, and I am here with a Western man, Jerry Hesch, the cowboy from Brooklyn, and we're going to talk about innovative charitable planning techniques. It is Saturday, 11 a.m. Eastern Standard Time. Jerry, where are you and what are you attending today?
I'm in San Diego attending the American College of Trust and Estates Council meeting, and it was very interesting. I picked up a lot of interesting aspects on charitable giving, especially Larry Katzenstein did a. I'm going to send you his materials. He did a presentation on private trusts and all the little traps and everything when private trusts make charitable contributions. And it was actually eye-opening because you think if you have a private trust, they can get an automatic charitable deduction for anything they give to charity. And private trust can, a regular trust can deduct 100% of its income with the charitable deduction. And if you don't do it right and your trust agreement is not drafted correctly, the IRS can disallow the charitable deduction in full. So you got to be real careful.
And if it's not done right from the beginning, you can't fix it. But you could drop the assets into a partnership entity and have the partnership make the donation, I think.
That was one of the things Larry mentioned. Very good, Alan.
And then if you have unrelated business taxable income in the trust, then you have an issue as well. And then you have to allocate.
No, it's like a private individual. You don't worry about that.
Oh, look at Code Section 681. It's in there. Okay, so anyway, why don't we get started? Welcome, everybody. I'm going to start in the middle here at page 85 and just make mention, because we have a lot of laymen on this call, people who are fortunate not to be tax lawyers or accountants. Everybody can donate $300 per person, $600 per married couple to charity and get a tax write-off. And I hope everybody on this webinar has done that or will do that for 2022. And then otherwise, to get a charitable deduction, you need to be over your itemized deductions. So when you add up your property taxes up to $10,000, medical expenses exceeding 7.5% of adjusted gross income, interest allowable on your home mortgage, plus charitable deductions, you're going to need to be over about $13,000 if you're single, about $19,000 if you're married, or I'm sorry, about $25,000 if you're married, before you can get that charitable deduction. So what you do is every 2 or 3 years, you make a large charitable deduction to be over the threshold, and you can make that charitable contribution to a donor advised fund or your own foundation or a community foundation, get the deduction, and then roll the money out at a slower period, over a slower period of time.
Alan?
Yes, question. Yes, Professor Hesch.
There are a lot of individuals, and of course here in Miami, Florida, there's a lot of what I call independent living facilities where people live in and pay rent. And there's a lot of very, people who make charitable contributions, and like 1,000 or 2,000 or 5,000 a year, and they don't have any itemized deductions anymore because remember, in Florida, there's no state income taxes, and more importantly, they sold their home and now they're renting in an independent living facility. So if they want to make a charitable contribution, they'll never get above the itemized deduction threshold. So what they do very simplistically is they put an income producing asset into a irrevocable trust, and the irrevocable trust is a separate taxpayer for federal income tax purposes. So you put some income producing assets in the irrevocable trust. The beneficiaries of that irrevocable trust when you die are your children, okay? And the income producing asset produces income, and the trust gives that income to the charity so the trust can offset 100% of its income. So if you give $5,000 a year to a charity, and you have a corporate bond of $100,000 that pays $5,000 a year of interest income, you put that corporate bond into a irrevocable trust for the benefit of your children. Every year, the charity reports $5,000 of interest income, gives it to the charity. The trust reports $5,000 of interest income, gives the $5,000 to your favorite charity, so the trust gets a full deduction. So $5,000 of income is offset, and the money goes, when you die, goes to your children.
All right. Now, by the same token, that's a really important thing. By the same token, if your client's going to die and leave 50,000, then instead of saying on death I leave 50,000, you can say after my death, the first $50,000 of income earned by the trust for my children will go to charity. So at least then that first $50,000 of income that your estate and trust earns after you die will get the full deduction. Because if you just leave it directly on death, you don't get the deduction.
Yeah.
And that brings to mind that if you know you're going to leave $100,000 to your synagogue or your favorite charity on death, why not do it now and get the recognition and the satisfaction and the income tax deduction?
Which is very important, Alan made, is if there's a lot of people of modest means who have significant charitable bequests in their will. Unfortunately, they cannot afford to give that money to a charity while they're alive because they need the income. So what you really do is, if you have like a bequest of $100,000, or actually say you have a bequest of, you say you have a couple with a net worth of $5 million, and that couple has $1 million bequest in their will, but they need the income from all 5 million, so they cannot afford to give the income to give it away now. So in order, but when you have a bequest, you don't get any charitable income tax deduction for a bequest. So they put the $1 million into a charitable remainder trust, and they get an income tax deduction for a portion of the value they put in the charitable remainder trust. And the idea is they retain the right to all the income from the $1 million for the rest of their life, and then when they die, it goes to charity. So it's a way for people of modest means who have charitable bequests in their will to get the benefits of the income tax deduction as well.
All right. So this and some other things are summarized on page 88, because they could also give a remainder interest in their home. You have somebody who's 80 years old and really wants to benefit the charity, and quite candidly may be a little bit afraid that the children will take that home away from him or her if they don't get it squared away. Well, they can give the remainder interest to charity. They can have the right to keep that home for their lifetime and get that tax deduction and not worry about whether they might accidentally sign a deed and lose the home. And the same is possible for the family farm. And what we see is that clients in their 70s will go ahead and give that remainder interest in a very loved property. And then in their 80s, they may go ahead and donate the life estate and get a second charitable deduction. So then Jerry mentioned charitable remainder trusts, and we're going to get into them pretty thick in a few minutes. Going back here, I want to just mention, Jerry, if I had a $5,000 a year bond, it's paying me $5,000 a year, and I want to give $5,000 a year to my local charity, am I better off putting that bond in a trust for my children that pays the $5,000 a year to charity, or transferring $5,000 from my IRA each year to the charity if I'm over 70 and a half?
Well, it's kind of neutral, because if you have money in your IRA, any distribution from your IRA is all taxable. So, but the nice thing about it is, if you give the $5,000 to a charity, it means, you know, it's tax neutral. And why is it? I mean, do you report $5,000 of income and take a $5,000 deduction, or do you not report the income and not take a deduction? And is there an advantage to not reporting the income and not taking the deduction? Alan?
Yeah. Well, if your minimum distribution is 5,000 or more, I think it's probably better to let that go to the charity. But if you're not taking anything out of your IRA or very little, then it's better to use the bond. But both of those things need to be considered. Now, another thing, Jerry, that I've seen and that people should know about is when you die and they sell your jewelry, when they sell your $100,000 diamond necklace, when you die, they're going to get $18,000 for it. But the regulations allow you to value that necklace based upon what a retailer would charge for a used necklace, which may be 65 or 70. So you take a 40% tax deduction or a 37% tax deduction against $40,000 differential, and the family comes out ahead a little bit if grandma just goes ahead and donates that necklace. Now, it needs to be used by the charity that receives it, and therefore it needs to be a display case type of situation, which is why when you walk through universities and colleges, there's all these display cases because they are actually using the asset. And this goes for cars as well. I've had some clients who have really enjoyed seeing their collectible cars auctioned off for a really, really nice cause. They get the tax deduction and the recognition. Jerry, any thoughts or ideas or stories on physical items?
Yeah. The thing is, like, you have jewelry that's worth $100,000. And the problem is that when you go to sell it, that's the retail value. But when you go to sell it, nobody's going to pay you unless you want to sell it yourself. But any dealer or something, they have to make money. So they're only going to pay you the wholesale value of the jewelry. And then, of course, they'll say the wholesale value of the jewelry of a $100,000 piece of jewelry is only $40,000. Because remember, they mark up the jewelry 100%. So what that means is you're better off in the end donating the entire jewelry and getting the $100,000 deduction rather than netting $40,000 of cash and then taking the cash and making a deduction for it.
Right. The next thing I wanted to mention is that
there is a scam that's out there. I call it the Bible scam. You go, they say go buy a bunch of Bibles at $10 a Bible, and then turn around and contribute that Bible at $20 to the charity, and able to get a charitable deduction of 40% times the 20. That's like $8. But the problem is the IRS says it's what you can sell it for. So it's not the retail value, it's the wholesale value. And the IRS, we call it the Bible scam. And the IRS says, anytime they find one of them, not only do they deny the deduction, but they hit you with penalties.
I had a client who was a major league umpire. So he would go buy a baseball bat for $25 and get a superstar to sign it. And then it was worth $2,000. And then he would donate it to a boys club for display. And he did a lot of that. So I think that was pretty aggressive, but just an idea and a way that the government subsidizes. Jerry, do you want to talk briefly about qualified conservation easements? Because that's similar. I have a beautiful ranch property. I want to keep it. I want to live in it. And I'm willing to basically restrict it so that it can only be used for ranch property. There can only be one house on the 30 acres. It has to be kept agricultural. And I give the right to enforce that to a conservation organization, a 501c3 organization. Jerry, any comments on that?
That is purely legitimate, because essentially you have land that is going to be, and you find this out in the Midwest and the West, where the ranch property has been in the family for generation and will be in the family for generation. And your ranch property is located within 20 or 30 miles of a fancy ski resort. So its highest and best use is 10 times its current ranch value. So in that situation, you basically dedicate the deed to say the property will always be used as a ranch land and can never be used for development purposes. So that means you have a conservation easement, and the difference, the value between the property as a development and a ranch land, you have eliminated that value, and therefore you get a charitable deduction for it. That is a purely simple thing, and it was designed, and the conservation easement deduction was designed for exactly that purpose. But suppose you're a dentist that is looking to build I shouldn't say dentist. Suppose you're a very wealthy individual who wants to buy buy in Val, Colorado or something. So there's these groups that I call their promoters that say, hey, we'll go buy that ranch land. Basically what they do is they basically say, we'll give you a conservation easement deduction. In other words, you're looking for a deduction. And then, so you go into their pools that buy these properties, and then they say you get a deduction for it. Those, the IRS, every time it finds those, audits them rigorously, and you see all sorts of case law on it, where the next conservation easement deduction was audited and allowed. When they approach you with that, those things work if you actually own the land and use it. Okay. But when someone is saying you're looking for a deduction, here's a great way of taking advantage of it, I would keep away from it. Or if you want to do it, to make sure it works if it's done right. So you better bring in an advisor to make sure it's done right.
Yeah. Okay, the next thing I want to mention is a lot of people have buildings that have been in the family many years, and they like to have the building, but they want to benefit charity as well. So if on the sale of that building you would have capital gains, then you can donate that completely depreciated building to a private operating foundation, not a private foundation, but a private operating foundation or a public charity, and take a full write-off of the fair market value of that building against ordinary income, and then allow your children or family to continue managing it and basically give 5.1% of the value of that building to charity, spending it on charitable activities. Go ahead, Jerry. I saw you had a point there.
One of the things is, because almost all real estate is leveraged with mortgages, and if you donate a more encumbered piece of real estate, the charity is taking over your mortgage. So effectively, the charity is purchasing a portion of the property subject to the mortgage, and the gift is the equity in the property. So essentially, to the extent that charity takes the property subject to the mortgage, you are deemed that to have sold that portion of the property, because the charity takes over your mortgage, and therefore you have gain to realize on a charitable contribution. We call it a part sale, part gift transaction.
Right. So it's best to pay the mortgage off completely before you do it. And then there's some exceptions relating to debt financing, and then there's exceptions to the exceptions. So keep the legal bill down by paying off the mortgage before you put the building in.
Yeah, especially when the property has a low mortgage, it's easy to do.
Right. I want to drive home, Jerry, that clients who have set up relatively small private operating foundations have gotten a lot of personal enjoyment and personal fulfillment from working with their children, working with their nieces and nephews, having the foundation pay their nieces and nephews to perform charitable activities in their communities or wherever that may occur. So it's not only the tax deduction, and it's not only having your name on a foundation, but it's actually working together with family members or other people to put together a brass band for your community, or to put together a scholarship fund for your favorite college, where you actively interview students, you actively mentor them, and you give them awards. So these are opportunities. And Jerry, a lot of times clients come to me and say, well, I was told by my lawyer and accountant that I need to put at least $5 million in this because it's going to cost $10,000 a year to run, and it's going to cost $20,000 to set it up. And that's just poppycock. You could set one of these up for $2,500, maybe $3,500, and put 10 grand in it and see if you like it. And then if you like it, you may put a lot in. If you don't like it, you close it. So
here's why it can cost a lot to set up a private operating foundation. When you set it up, you have to submit a memo that talks about how it's going to operate, what it's going to do, how it's going to get its funds and everything. And that, if you let the lawyer draft it, it will take the lawyer 5 to 10 hours to draft it. But it's basically your business model. So to eliminate that lawyer cost, you draft the whole business model for the private operating foundation yourself. That's how you can save the money.
Yeah, I just give the clients 3 sterilized examples. They could pick one of the sterilized examples, or they could draft their own. But the IRS has been approving a paragraph about this long. I'm going to set up a scholarship fund for people who went to my college, who also went to my high school, and we're going to actively interview them, recommend them, and mentor them. XYZ, thank you very much. So it's not that hard to set up a charity. I hope more people do it. And then another alternative at the bottom of age 85, and this is really nice because if you're out of COVID and you're unmasked now in your backyard, have a party for a charity. The charity will pay for the party. If you have it at your home, you can make a donation to the charity. They'll pay for the party, and they'll generally raise an amount equal to or greater than what it costs to have the party. So just another little idea. Of course, you do have to renovate the home before the party to clean things up. You can't write that part off, I don't think. Just another couple of ideas. If you get in a fee dispute, or you have somebody who wants a free consultation and you're a CPA or a lawyer, what we sometimes do is say, we don't give free consultations, but if you want to donate the money to the All Children's Hospital in St. Petersburg or St. Petersburg College, your choice, then I'll be glad to meet with you, and you write a check to them when we're done with the consult. And you know what? If they won't do that, then probably they weren't going to be such a great client anyway. So, Jerry, I want to make sure we have plenty of time for your charitable remainder trust stuff. So why don't let me see if I can find it here.
It's back at the beginning.
Start with page 16.
Yeah, we can start there. What's interesting is there are a lot of people who they're not that charitably inclined. They'll give a few $1,000s a year to charity, but when you ask them to give $100,000, they say, why should I do it? And one of the things is that you can actually be financially better off by giving money to charity, but you don't give it outright. You give it into charitable trusts. But the difficulty is that these transactions, we call them charitable split interest trusts, for charitable remainder trust, charitable lead trust, we're starting to use technical terms that are not found in the vernacular. And one of the problems that we have is the lawyers and accountants who know this stuff cold have a problem. They'll talk about it in very technical terms, and clients do not necessarily know what like a reverse Q-tip is or a zeroed out clap. And you start using these technical terms, the clients are not going to follow you that closely. So the key is, and this is what I tell my students, if you really think you know a tax planning technique well, that's great. But the key is not that you know it well, but your ability to communicate it in an understandable manner. And I always tell my students, when you go visit your grandmother in Boca Raton, Florida, and you can explain it to your grandmother and your booby understands it, then you know you have developed the communication skills. And a lot of the charitable giving is complex. So the easiest way to communicate it is not to describe it in general terms, but use simple to follow numerical examples, because it's all in communication. For those of you who are advisors, the key is how can you explain it in an understandable manner? And so we're going to use numerical examples to show you how we illustrate some of this stuff. Next slide. Okay. Now, also, what you tell clients is, with a properly structured charitable giving technique, there are significant estate tax benefits and income tax benefits. And what I tell the client is, suppose you have a $100,000 asset with no cost and you sell it for a $100,000 gain, and you have to pay like $30,000 in income taxes on it. So I tell the client, with a properly structured charitable technique, how would you like to give that $30,000 that you would otherwise pay in income taxes to the charity of your choice? And they say, well, wait a minute. I'm going to net 70,000 if I sell it. So you're telling me I'll still net 70,000 and give that 30,000 in taxes instead of to the IRS, to the charity of my choice? That's great. And that is something also that you can use to communicate to your clients to get them to give to charity when they see they can actually be better off. Would you rather give the 30,000 to the taxing authorities or to your favorite charity? Next slide. Okay. All right. So, and here's another way of illustrating it. Okay. And because what we're talking about is getting the client interested in doing some significant charitable giving. So here's another simple example. Senior borrows $1 million from a lender at 1.87% interest. Okay. That means that the interest expense is going to be $18,700 a year. Okay. So basically, Senior takes the $1 million and puts it into a corporate bond paying 2.87% annually, or $28,700 a year. So Senior is using the bank's money to earn $28,000. It only costs Senior $18,000 to use the bank's money. Senior is $10,000 better off. So the key is, in this situation, Senior can actually take that $10,000 and give it to a charity, and it really doesn't cost Senior anything. Well, it turns out in a situation like this, the lender can be the IRS when you use some of our charitable remainder trust techniques. So essentially what you're doing is basically, it doesn't really cost you anything to give $10,000 a year to charity. And so now we can get into some of the techniques that actually, but this is just a way of giving people with examples of here's how to consider how you can actually give money to charity, which doesn't cost you anything really. Okay. And we covered this, but Alan, you can go through it again.
Well, it's your example, but I see that Mr. and Mrs. Senior, and by the way, for the lawyers and accountants out there, it's nice if you call them Mr. and Mrs. Senior, because then you don't have to say that they're the parents of Junior. It just happens as part of the story.
There's actually also sometimes you can't remember all the names of everybody. And me being teaching, it was very easy to remember names because I had a seating chart with all the names. But so you have Mr. and Mrs. Senior, they got go through the example, Alan.
Yeah, so they're 71 and 69. They have a $6 million investment portfolio. It's generating about $300,000 a year, and they're spending all of that on their living expenses and to pay their income tax on the income. So they haven't been making large charitable contributions because they have felt like they don't really have the cash flow to do it. But they have intended to give $1 million when they die, and they're not getting any income tax benefit from that pledge at the present time. So what they do is they form a charitable remainder unitrust, which is a document which says that for a certain period of time, payments will come back to them, and that after that period of time, whatever is left in the charitable remainder trust will go to charity. There's two types of charitable remainder trusts. There's the charitable remainder annuity trust, which would pay them a set dollar amount each year. And then there's a charitable remainder unitrust, which every year pays a percentage of what's in the trust. So they set up a 5% per year charitable remainder unitrust. So every year, the trustee of the trust, which can be them, will determine the value of the trust, will multiply that by 5%, and will write them a check. And if the trust happens to earn 5% a year, then they'll get $50,000 a year for the rest of their lives. And at the end of the day, the charity will get its $1 million. But what makes it a little bit sweeter is a $409,640 income tax deduction. So they won't be paying very much in income taxes for a number of years to reward them for their generosity. Am I right, Jerry?
In other words, you don't get a charitable income tax deduction for a charitable bequest in your will. But if I put it into a charitable remainder trust and using their ages, it's a $400,000 immediate charitable income tax deduction, which means the $50,000 a year that they would otherwise have paid income taxes for the next 8 years, the charitable deduction can offset that $50,000 deduction. So what they've done is converted, they don't have to pay income taxes on their first $400,000 of income.
So Jerry, is this a lifetime charitable remainder unitrust? It's going to pay 5% a year for however long?
Yeah, because they need the money for their living expenses for the rest of their lives.
Right. Yeah.
And the nice thing about it is when they set up this charitable remainder trust and designate their favorite charity, then their favorite charity will start inviting them to all sorts of events to get them to give more.
To use them as an example. But they can have the right to change who the beneficiary is, correct? Anytime they want. So if they don't get invited to those events, maybe another charity will end up with it. But could they change the charity, Jerry, to their own private operating foundation?
Yes, because here it's simple. It's a bond. There's nothing wrong. There's no complications. It's not like an operating business or something like that. So it can be any kind of charity, public charities, private foundations or private operating foundations or donor advised funds. It doesn't really matter.
Jerry, let's say that they have $1 million worth of Amazon stock that cost them $100,000, and they've been wanting to diversify. Can they put that $1 million of Amazon stock into this, and would they get a $100,000 tax deduction or $1 million tax deduction?
Well, remember, if they put it into a charitable remainder trust, it basically says the $1 million is going to go to the charity when I die. So it's not a $1 million deduction. It's the present value of the right to receive $1 million when you die. But you still, the nice thing about it is charitable bequests, no income tax deduction. Putting it into these charitable trusts, okay, you get an unbelievable income tax deduction, and you haven't changed the economics of it at all.
So they put the $1 million of Amazon stock into the charitable remainder unit trust. The trustee sells the $1 million worth of stock. And do they have to pay capital gains tax when the trustee sells the $1 million worth of stock?
No, the charitable trust, it doesn't pay income taxes. So in that situation, that in other words, they were going to sell the $1 million of stock and pay income taxes on it and say net $700,000 after taxes. So they would have the income for the rest of their lives from $700,000. By putting the $1 million stock in a charitable remainder trust, it doesn't pay any tax on its gain. So now the income from the charitable remainder trust that you retain the right to receive is not the right to receive the income from the $700,000 if you had sold it outright, but it's the right to receive the income from $1 million. So basically, you're going to give the $1 million to charity when you die, but if you intend to sell the property while you're alive, you have $1 million to provide you income for the rest of your life instead of the $700,000 if you sold it outright and paid the taxes.
Right. And even though your cost basis is only $100,000, you get to use the $1 million multiplied by the factor for the remainder going to charity to generate a $409,000 income tax deduction. So
you also get that wonderful income tax deduction up front.
Right. So I see why you say that this couple is much better off financially from a cash flow standpoint by doing the charitable remainder trust as opposed to waiting to do the $1 million on death.
And our objective here is to encourage charitable giving. And so what we're telling you is, here's all the examples that you as an advisor to clients or potential clients can use. And feel free to use any of these examples because our objective is to encourage charitable giving for the public good.
Right, exactly. And that's so much appreciated, Jerry, because you've been such a contributor to that. Now, Jerry, as to flexibility, let's say that they do this and they just feel great about it. And they say, I'd just like the remainder to go to charity now. My income interest is worth, after maybe 3 or 4 years, my income interest is worth $500,000. Can they just turn it all over to charity and deduct the value of what they're walking away from?
Yeah, well, using this example, okay, the present value of the $1 million going to charity is $409,000, which means, and let's make it 400,000 so it's a nice even number, which basically means that they have retained a right to income for the rest of their lives worth $600,000. Okay, and now, interestingly enough, that income that they've retained is going to be ordinary income taxable at the highest rates. And they decide, you know something, I still need the right to that income, but the charity needs the $400,000 today. So what they do is they terminate the charitable remainder trust And the charitable remainder trust then has to divide the $1 million between the value of the right to their income for the rest of their life, which is $600,000, and the $400,000. So by terminating the charitable remainder trust early, the charity gets $400,000 of cash or assets up front immediately, and you get $600,000. But because a termination is that $600,000 that you receive, instead of it being ordinary income, is treated as a long-term capital gain. So instead of having $600,000 of ordinary income, as an ordinary income, it's $600,000 of capital gain. So you reduce the income taxes on the $600,000 by about 20%.
It's really nice. Okay, let's see what you have next here.
Now, interestingly enough, when you put money into a charitable remainder trust, you get a charitable deduction equal to what you expect the charity to receive when you die. Okay? Alan, go back to slide 13. Okay, go back to slide 12. Okay, all right. Now, interestingly enough, so if I put money into a charitable remainder trust and retain the right to all the income for the rest of my life, and then when I die, what's in the trust goes to charity, you can't really look at everybody's life expectancy individually. It's impossible. So in determining when the charity is going to get the money in the charitable remainder trust, the IRS uses what are called standard mortality tables. And it doesn't matter what the actual health of the individual is. Everybody is presumed to have a life expectancy based on the mortality tables that the IRS is required to use. Okay, so if you look at the mortality tables that the IRS is required to use, and you take somebody who is age 70, they have a life expectancy under these standard mortality tables of 14 years. Okay, so what this means is everybody is subject to the same mortality tables. Okay, now the problem is that the mortality tables the IRS is using is based on the year 2000 census data for the US population as a whole. So in the year 2000, the average person in the United States who's age 70 has a life expectancy of 14 years. So in computing the charitable deduction, the IRS is required to use those mortality tables and basically is required to assume that a person age 70 will die exactly 14 years from now. So they determine what is the value of the right to receive the money in the trust 14 years from now. Okay. Here's the problem with these tables. Number one, it's based on the census data of the United States population as a whole, which means people who are living in poverty are part of that survey. And our clients are wealthier than the average US population as a whole and have a longer age 70. So basically someone age 70 today, hey, that's young. You're not there yet, Alan, but you will be in a few years. Okay.
Yeah. Yeah.
But my buddy Ken Bloom is listening in, and he's 77 years old, and he expects to live another 20 years. Okay. So essentially, the people who give to charity have longer life expectancies than what is shown in the US Census data. But more importantly, these tables are 22 years old. And the IRS, because of COVID and everything, has been so overwhelmed that they haven't been able to update these tables. So if you give something to charity today, you're using tables that understate your life expectancy. So go on to the next slide. Okay.
So it exaggerates the value going to charity.
Exactly. So the next slide here. Now, also, what's interesting is when you say you have a life expectancy of 14 years under these tables, all that means is there's a 50% probability you'll still be alive 14 years from now. As a matter of fact, under the same tables, for someone age 70, there's a 32% probability they'll still be alive at age 90. So if someone contributes $1 million to a charitable remainder trust for their life, okay, they would get a charitable deduction for the charitable remainder interest based on the fact that they would have the charity would get it 14 years from now. So basically using my example with a 5% unit trust interest, if you put $1 million into a charitable remainder trust and retain the right to all the income for the rest of your life, the charitable deduction assumes that you're going to die exactly 14 years from now, and your charitable deduction will be $525,000. However, I'm sorry, I screwed up. Okay, sorry. The charitable deduction is $525,000 because it assumes the charity is going to get the money 14 years from now. But you know, our client says, I'm going to live into my 90s. Well, if we basically think if the client lives to age 90, he's receiving the income for an extra 6 years, and the charity's receipt is postponed by 6 years. So the present value of the right to receive this property in 20 years is far less. So in that situation, it's $366,000. So essentially, you're getting a extra $159,000 charitable deduction based on the use of these out-of-date mortality tables, when in reality, what you're giving the charity is only $366,000. So you're almost $160,000 better off.
Wow. Jerry, do you think that the 75/20 rate that's also used in these tables is going to go up before the end of this year? And does that help the charitable deduction or hurt it if the rate goes?
Well, it's interesting because in the charitable remainder unit trust, whatever the discount rate is for under the section 75/20 is irrelevant, because in a unit trust, I'm not going to get into the math, but in an annuity trust, the 75/20 rate goes up. So in effect, if interest rates go up, the discount rate also goes up, so your charitable deduction will be less. So essentially, if you're going to do a charitable remainder annuity trust, you should do it now before the 75/20 rate goes up. But if you're going to do a uni trust, which is not sensitive to the discount rate, it doesn't matter when you do it. Okay. So, but in today's environment, what's interesting is you get a bigger charitable income tax deduction up front for a charitable remainder uni trust than a charitable remainder annuity trust. So today, until the 75/20 rate exceeds 5%, we always have our clients do uni trust instead of annuity trusts. Okay.
Gary, I've got another question I keep forgetting to ask you. I've never seen anything written on this, and that is the client can be the trustee of the unit trust or the annuity trust. Should they take a trustee fee? Should they take a reasonable trustee fee? Maybe on $1 million, that might be $5,000 a year. They're creating taxable income, but they're also getting more money out. Have you ever looked at that question?
Well, unfortunately, I've had people say, you can be the trustee of your own trust. And as a trustee, you're managing the investment portfolio and everything. You're entitled to a legitimate fee. And, what's a legitimate fee for managing $1 million? Well, if you go to your financial advisor for assets under management, they charge a fee. They say, we'll charge, regardless of how much money we'll make, we'll charge a fee equal to 2% of the value of the $1 million or $20,000 a year. Okay? But the client says, well, I'm going to personally manage it and I'm going to charge a fee of $50,000. And the bottom line is, I tell the clients, you're going to take $50,000 when an investment manager who's more sophisticated will only charge $20,000. I highly recommend you only take the $20,000 that an independent third party would charge.
Right, but you have to pay income tax on that, right? And does the trust get a deduction when it's paid?
The problem is that reduces the amount of money in the trust. So when I tell the clients they can't take an outrageous fee and they say they only can take $20,000, I say, why don't you waive your fee, and there's more money in the trust to have more money earning income from you going forward in the future.
Right. Okay.
There's no problem with a legitimate management fee.
Super. All right, so Jerry, we scheduled this for an hour. We got about 8 minutes left, but we can go over, and our audience, likes when we go over. What would you like to cover next? Do you want to cover a charitable lead annuity trust or anything in particular?
The shark fin clap.
Right.
Okay. Now, the opposite of a charitable remainder trust is a charitable annuity trust. And if I put $1 million a year into a charitable trust, and instead of retaining the right to the fifth, and let's suppose it's my corporate bond that pays $5,000 or $1 million pays $50,000 a year, okay? Now, instead of retaining the right to the $50,000 a year and then the remainder goes to charity, what I do is, in a charitable lead trust, is I say the charity will get $50,000 a year for the next 20 years. And then at the end of 20 years, whatever is left goes to my children. Okay. And you get a charitable income tax deduction and a charitable gift tax deduction for the present value of the right the charity has the right to receive $50,000 a year. So essentially, in that situation, okay, so basically what happens here is the key is that the money in the trust earns income, and the IRS assumes in today's environment that the income producing asset is only going to earn what's called the Section 7520 rate, which is currently 2%. So if I have a $1 million bond earning 5% or $50,000 a year, and I give $50,000 a year to charity as a charitable annuity, the IRS is assuming it's only earning 2% or $20,000. So if I'm giving $50,000, the IRS assumes the extra 30,000 is principal. And it over 20 years, that amount of principal that is artificially being depleted, even though it's earning really 50,000, has a present value of $1 million. So I get a charitable deduction of $1 million for $1 million going into the trust. So that means the value of the remainder interest going to my children at the end of 20 years is zero. And we call that a zeroed out CLAP. So the key here is, again, the more money in the trust, the more income it can earn. And if I start, but remember, the charitable deduction for the charitable lead trust is the present value of all future payments. So now normally people would say 50,000 a year to charity for the next 20 years. But the key is I can vary the payments for a charitable lead trust. And I can have the payments be low in the beginning so there's more principal earning income. And what happens is, in that situation, the extra income goes to my children, free of all gift and estate taxes. So here's an example. Senior has a asset worth $80,000 that's paying a corporate bond that's paying $41,702 a year to charity each year. Okay. So let's suppose that the individual puts that into a charitable lead trust, and the present value of $41,000 a year, because it's only assuming it's earning a lower amount, is depleting principal. So the charitable gift to my children of the remainder interest is zero. So let's look at how that works financially in the next slide. Okay. What happens here is it's earning, say, 5% or $40,000 a year. So what that means is every year that it earns 5% on the principal, every year the charity gets 41,000. And what happens is at the end of 20 years, there's $743,000 that is given to your children at the end of the term with no estate and gift taxes. But in this situation, you can see I'm depleting principal. So let's go on to the next slide and change the assumptions.
By the way, what was the ratio of this? What was the value of the charitable deduction? 100%, right?
100%.
Okay.
So basically, what's left for the children is zero.
Okay, so you put 800,000 into this box, and this box pays your favorite charity 41,000 a year. You get an $800,000 income tax deduction when you set it up, and then
tax deduction.
What's that?
And a gift tax deduction.
A gift tax deduction. And even though at the end of year 20, in the greatest quarterback sneak of the tax world, $743,000 goes to your descendants, estate and gift tax free. That is pretty darn nice.
Right. Now let's change the assumption, because the more money in the trust, the more income it can generate. But let's change the assumption that the charitable annuity will start low and increase by 20% a year over 20 years. But I still basically have a value of the charitable annuity being the same 800,000. So the taxable gift to my children is zero. So now remember, in the previous example where you had level annual payments, there was like a little over 700,000 went to the children. So let's look at the next slide. Okay. It starts out real low. And it basically doesn't get up to 40,000 until year 13. So you have more principal earning 5%. So all of a sudden,
Wow.
If I increase the payments by 20% a year with more principal earning income that will go to my children, at the end of 20 years, there's $1 million that goes to my children free of all gift and estate taxes. So can I actually increase the benefits of this? And the answer is yes. Next slide. It's called the shark fin clap. Now remember, the payments are not just the present value of all future payments. It doesn't have to be level. So let's suppose the charitable remainder trust on the next slide says for the first 19 years, I'm going to give $1,000 a year to charity, and in year 20, I'm going to give the charity $846,000. So the present value of all those payments is still the same $800,000, but since I have more principal earning income, at the end of 20 years, instead of there being $1 million going to my charity, 1.2 million goes to charity. So the key is the more money in the trust that the income it earns in excess of the 75-20 rate goes to my children. So you like to have the payments in the charitable lead trust deferred. And in this situation, we call it a shark fin because it looks like a shark fin.
Right. Jerry, has the IRS said that they like shark fins or they don't like it? Can I sleep at night if I do a shark fin?
The IRS has issued several private letter rulings saying that in a charitable lead annuity trust, it's the present value of all future payments. So the IRS in unofficial guidance likes that. And if the IRS has to issue those rulings because that's what the law says. Okay, it's the present value of all future payments, and charitable lead trusts can vary the annual payments in the annuity. Now there's a gimmick where people use that they put life insurance inside the charitable lead trust. And we call that a gimmick because there's an Internal Revenue Code section that says that a charitable lead trust cannot pay the premiums on a life insurance policy. So, but the shark fin clap is an acceptable technique. The IRS has issued several private letter rulings that approve of it. And, you know, and if Congress, and if the IRS doesn't like it, they have to go to Congress to change the statute. And the bottom line is the charity is still getting all that money. So a lot of people say, oh, look, my charity is going to get $800,000 at the end of 20 years. Nothing wrong with that. So basically, I don't see that legislation being changed.
Right, right. Okay, Jerry, let's go over a couple questions, and then I want to talk about the Notre Dame Tax Institute also before we forget.
Okay.
Here's a question. I love the fee dispute idea, but how do you verify they donate it to the charity? Well, once they agree on the charity, I give them the name of my contact person at that charity and ask the contact person to confirm once they've received the check. Secondly, the charitable deduction is only 50% of AGI and the carry forward is only 5 years. That's correct, and we didn't mention that. If you give more than your...
No, it's 60% now.
60% for cash or 60% for anything?
60% for, oh, I'm sorry, it's 60% for cash. And in a charitable trust, you're not giving cash. You're giving them an interest in the trust. So it's 50%. But the key is, if you don't use it this year, you have another 4 years, another 5 years to carry it over and use it in the future.
And then somebody said, in 2021, I made a charitable deduction of $150. Can I deduct $300 or $150? The answer is $150. And then for the Crotty deduction of $409,000, is that restricted to a percentage of adjusted gross income, Jerry?
Yeah, it can't exceed 50. It can't exceed 50% of your adjusted gross income. Now here's the key is, if the remainder beneficiary in the charitable remainder trust is a public charity, you can use it to offset 50% of your income. If the remainder beneficiary in your charitable remainder trust is your private foundation, you can only use it to offset 30% of your adjusted gross income. Or is it 20%? I forgot. It's less for a private foundation.
Private foundation appreciated assets 20%.
It's 20%, right?
Yeah. Okay.
But you still can carry the excess forward.
Right. Right. Okay. For the CLAD example, Jerry, is the growth based on stocks and bonds in the portfolio?
Exactly. Now, when you do one of these charitable remainder trusts or charitable lead trusts, you can't leave it alone. You have to have somebody managing the investment portfolio, because it's very important to make sure you have the right asset mix. In a charitable remainder trust, you got to pay out a certain amount, and therefore you want the cash to be available, so you can't have it all in growth stocks, or you're going to have to sell some of the stocks. So the most important thing is, when you use a charitable remainder trust or a charitable lead trust, someone has to watch the store financially, to watch the investments and make sure the investments are managed in a manner that will make the payments.
So let me just mention again, for the charitable remainder trust, the charitable lead annuity trust, the 800,000 is the exact amount the client puts in. And then the payment schedule here is the exact amount of payments the clients will get. The exact amount of payments the charity will get. The 5% growth is hypothetical. If the growth actually 6 or 7%, then the remainder will be much larger. If the growth is lower, then the remainder will be lower. Now, here's one last thing for everybody, especially you planners. I feel very fortunate to have been able to recommend to some wealthy people, 5 or 6 families, why would you leave everything to your children in the IRS when you could leave it to your children in charity? And the client says, what do you mean by that? And I said in the most recent conversation, well, your children are getting about 50 million free of estate tax. And then there's about 100 million that's going to your children in the IRS. Would you rather that 100 million go to your children in charity? And the client says, well, how does it work? And I say, well, when you die, we'll leave everything over an amount sufficient to get your children 50 million to a charitable lead annuity trust, which will pay charities selected by your children certain amounts over 20 years. And at the end of the 20th year, what's left will go to your children. And if your children manage it properly and the stock market does what it's historically done, it's going to end up over 50% or around 50% in the hands of your children in 20 years. They'll just have to live off the 50 million for the first 20 years. And when the client says yes, you can feel pretty good that a lot of money will be going to charities, and that keeps the children together as well, because they can run the charitable foundation together, and they do that pretty well despite the fact that their spouses may not get along. Such is life. Jerry, tell us about my favorite annual event besides Marcia's birthday, and that is the University of Notre Dame Law School Estate and Gift Tax Institute.
Yeah. Every year, I'm the director of the program, so I put it all together. And the next Notre Dame tax, the last 2 years, it's been virtual. And that means nobody would be able to go to South Bend, Indiana for a football game. Yeah. This year, we tentatively scheduled it to be live November 10th and 11th of 2022. And hopefully it will be live. And the way things are looking, as more and more things are opening up and the pandemic is more and more controlled, that it will be live. And the Notre Dame, and the nice thing about the Notre Dame Tax and Estate Planning Institute, it's only a 2-day program. because after 2 days, you can't sit in a room listening to lectures. But it's, it's in South Bend, Indiana. It's a nice area. You can go visit the campus and things like that. And the kind of things that we do here in Alan's seminars, these are the kind of topics that we have at Notre Dame as well. And we have topics that are geared not just for people with multi-millions of dollars, but we have topics that are geared for what I call people who are financially comfortable, but are not really exposed to estate taxes significantly. So there's a lot of practical topics that cover things that are needed that don't necessarily have to do with saving taxes.
Yeah. And things I really like about the Notre Dame Institute. Number one, Jerry designs the topics and the talks. He doesn't just call speakers and say, hey, can you give that same old talk again for me this year? He tells the speaker what needs to be covered. He gives the speaker a full 60 minutes, which makes a big difference. The difference between 50 minutes and 60 minutes is immense. It's really makes a difference when you're a speaker trying to get layers of information and planning techniques out. And then the third thing is it's a dual program. So every hour, for most of the hours, you have your choice between room A and room B. And room A is usually a bit more fundamental. Room B, more complicated, more advanced. The attendees mix up very nicely. It's a really, really pleasant program. If you don't want to fly into South Bend, which Southwest Airlines will take you to South Bend very efficiently, but you could also go spend some time with your relatives in Detroit or Chicago or one of the other cities that's really not far from South Bend, and then drive into South Bend, enjoy the football game, and see Jerry and a lot of our friends there. Jerry, any parting words here for us?
No, that's just, I'm here in San Diego, so I'm going to go get some breakfast now. And thank you, Alan, for inviting me. I always appreciate it.
Yeah, thanks a lot for all you do, Jerry. We'll have this posted to the YouTube site in about 2 hours. All the attendees will receive a copy that you can click to, forward it to your friends. Next week, we're going to talk about what estate planners need to know about Florida law for snowbird clients, and what physical therapists and yoga therapists should know about each other. Then the following Saturday, we're going to talk about spousal limited access trusts. And a PhD in electrical engineering is going to talk about estate planning and what he's learned from all our webinars. And then finally, Marty Shinkman is going to join me April 9th, and we're going to talk about hot topics and best strategies for estate tax planning. And Marty's going to lead on the human aspects of estate tax planning. So that's all going to be interesting. Please send us your questions, comments, and suggestions. There's nothing I like better than me getting together with you on Saturday at 11 a.m. So we'll continue to do it until Marcia says no way anymore. Thanks again, Jerry.
Thank you. Take care.